All right, now the theme what we are debating, discussing and deliberating this week on ET Now is that why are foreigners selling into Indian stocks, how long they are likely to sell, and what really could be the big turning tide for Indian equity markets. Globally, foreign institutional investors in last couple of weeks and months, they have either moved asset away from emerging markets to US, or within emerging market, China seems to be getting a priority. Now, every day we are getting, I won't use the word relentless, but an outflow. And the outflow for this year, and just been 2 months, guys, is about 1.5 lakh crore. So is it the strength in the dollar? Is it readjustment of the world in terms of what the new Trump map is? Or this is pure profit booking in emerging markets like India, which were expensive and which now which in a sense became a challenge for long-term investors as the valuation and earning mismatch was there. So why are FIs selling? How long they would sell? And to get that answer, I have a very special guest. The company or the firm he represents is managing broadly, hold your breath, $2.2 trillion of assets under management. Yes, you're right. $2.2 trillion of assets under management. Florian Neto, Head of Investment Asia with Amundi, joins us. So nice to have you on ET Now. Thank you for joining us.
Thanks for having me.
And your fund, the firm which you represent, is managing $2.2 trillion?
Yes, true.
So that $2.2 trillion, you actually manage that much of money globally?
We manage that much of money.
How much of that is in equity?
30% of it is in equity, roughly. We have as well a passive investment, but passive is smaller than our active share in terms of stock.
So I'm putting some maths here, 2.2 trillion, 30%, that makes it about 600 to 700 billion dollars. So globally, the fund which you represent is actually managing 600 to about 700 billion dollars of direct and indirect equity investments.
Yeah.
You're the right man to tell me why FIs are selling India.
Yeah, I will try to help to understand, but I'm not the one responsible for that, I can tell you.
Okay. So you're not the villain.
I'm not the devil.
You're not selling India. You like India.
I'm not the devil. And we have been buying back India last week, actually, but we can come back to that.
Okay, so now you've given me a hint not to ask you a difficult question now that you've already said that you are not selling India. Let's start with your view of the world. We've seen a big rally in US markets. Till about last week, it appeared that nothing could go wrong for US. Now suddenly it appears that nothing is going right there. What is happening?
What's happening is that the market was pricing, the issue in the US is potentially inflation, and we've seen this inflation over the full last 18 months. Over the last weeks, what we see now, and we will come back to the US administration policies, you see that now there is a growth scare, mini growth scare in the US. Consumer sentiment has been coming down. Everything linked to surveys is coming down. You have the Atlanta GDP now from the Fed, Atlanta Fed. GDP now, so it's a very short-term indexes incorporating all the macro data. January, plus 3%. The US exceptionalism was still there. February, minus 3%. Normally, you don't have those kind of gaps. So definitely everything we got from PMI, University of Michigan, ISM, trade data, housing data, everything has been a bit below expectation of late, and it was not what we were expecting in the US for a long time. We were not seeing that. So things are changing. If I can dip deeper into the US administration and US policies, it seems to us that they are designing a new world order. They are changing trade policies, fiscal policies, immigration, energy, defense. So eventually, all the CEOs, all the other countries have to adjust to this change of paradigm from the US. The doctrine, if we take a step back, is the MAGA doctrine. Basically, you cut tax domestically and you increase levies on other products. You drill more oil. Why? Because you want to extend the cycle, but to make sure it's not too inflationary. And on the security, it's quite interesting, and we had a big move on the bonds in Germany yesterday. On the security, the message is, if you want the security, either you pay for it, and it has been clear for Taiwan last year. Taiwan has to pay for it, and you may have seen that TSMC has been investing 100 billion, I've been mentioning that, 100 billion in the US. Or you find new allies, and what we see in our region, in Philippines, for example, Philippines is having a lot of difficult situation on the Southeast Asia seas, and they are getting closer to New Zealand. New Zealand is not the US, but New Zealand is providing potentially some help. Or you take care of yourself. And this is where Eurozone and European Union is. At the Munich conference 2 weeks ago or 3 weeks ago, J.D. Vance came and a few other US administration and say, the issue is not Russia, the issue is not elsewhere, it's internally. You're not spending enough on defense, and you cannot count on your US anymore. Friedrich Merz, the new chancellor to be of Germany, first introductory speech was saying, my first priority, and it will be step by step, but my first priority is to make sure we are getting less dependent from the US. And yesterday they announced a big fiscal plan dedicated to defense and security. And they mentioned that it won't be included into the 3% fiscal budget that they want to keep in mind. So I think this is a change in paradigm. If we take a step back, what does it mean for assets? First, on Asia FX, you mentioned about the dollar. I do believe, and we do believe at Amundi, is that on Asia FX, most of the moves that we've seen has not been very detrimental so far. Okay. So the impact from tariff actually, we are hearing about tariff every day, but in Asia, only China has been targeted so far. So you have friends and foes alike, because Mexico and Canada. So on tariff, you have to look into what is signed and not try to predict the unpredictable. Okay. And on Mexico and Canada, we do think they can reverse it back because it will be too costly for the US growth and US inflation. So from the market, what is the objective of the US administration? Trump 1.0 was S&P should be going up. If S&P is going up, wealth effect for US consumer, I will be very happy, they will re-elect me. Now it's different. Initially he said, it's the short end of the curve, the Fed fund rates. I put pressure on Mr. Powell. And eventually it's put a big issue because then the Fed dependency is at stake. Scott Bessent was very clear now. They target the US 10-year. They want the US 10-year to move lower in terms of yield to make sure they reduce deficit and they have a lower dollar so that they can onshore a bit more US manufacturing. You may ask if it's possible. Frankly, US manufacturing, you have a labor shortage for manufacturing in the US those days. But this is what they are trying to achieve. And this is what has been happening bit by luck, because the macro momentum in the US is going down, then the curve has been moving down a lot. And the market is pricing now 3 cuts for this year in the US. Okay,
so I'll just summarize the part 1 of our interaction. Your view is that the priority of Trump 2.0 is to keep the US economy alive and kicking, bring interest rates lower, and ensure that the dollar remains strong. Weak, sorry, so that they can export out.
Yes.
Okay. But dollar actually has hardened. So the strength in dollar, if I may say so, at least your analysis seems to be indicating that it is temporary and dollar actually has to go down and emerging market currencies have to strengthen. That's part 1 of the interview.
Yes.
Part 2 of what you've just summarized is that you think the excesses in the US market which happened after Donald Trump got re-elected, those excesses now have reached a turning point, and now both the excesses in the S&P and in the bond market, they need to correct themselves.
1, on the US dollar depreciating, it's happening already, but not versus rupiah or versus some emerging currency, but it's happening already versus yen, versus euro. You may see that the euro has been moving 5% already, appreciating. The yen as well have been moving 10% over the last 3 months. So the dollar has been depreciating in trade weighting terms, but not versus some specific EM currencies. Second point, we are strong believer, and it's part of our outlook for this year, that the US performance, the way the design of it was not sustainable. It was too concentrated, lower breadth, and indeed those stocks, those Max 7 stocks, deserve to perform well because they have been having strong guidance, strong earnings, high bar, and they have been matching the bar or exceeding the bar. But we do believe now that the S&P will perform less than other markets, because S&P the performance should broaden to other stocks and other sectors. And we do see as well flows moving out of the US and into other areas where they can find more valuation appealing stories there.
So we'll get this flash out. The head of investment Asia for Amundi, Florian, feels that US markets have peaked out in the probability of money moving out of US, according to US, higher in next coming days or in coming months. That's first story.
We believe the S&P can still go up, but not with the leadership of the Max 7.
Great. So US tech stocks, as we famously call them, the so-called famous 7, famous 5.
We are very selective on them.
You're very selective on them. Okay. Out of the $2.2 billion which you manage, where are you right now overweight? and where are you right now underweight at a global level?
At a global level, we have another weight on European equities,
Okay.
we have another weight on India equities, and we have now a tactical overweight on China equities. Okay. So this is how we are rebalancing a bit our overweight of the US that we have been having for a long time, and we are coming back neutral on the US. Then on the fixed income side, we are positive on duration, and we have been positive on duration. Today, on the curve in the US, we do feel that a lot is priced in. We have 3 cuts in our central scenario. We are now priced in for 3 cuts. And we do think that the US growth scare is temporary. We do think that the US growth will still be there and they will deliver 2% for this year. So we tend to tactically reduce our duration today from a high level. We are taking some profits from the recent growth scare that is priced on the fixed income markets. And we remain very positive on credit, on IG credit. Even if you don't have a lot to make there, we're still positive because we don't think the issue in terms of leverage and into issue in terms of profitability. So as soon as the Fed may stop there and cut sporadically going forward, but the financial condition will keep on being a bit more accommodative, especially if we have in mind that the dollar will be depreciating a bit along the road. So it's still a carry and credit environment in our view.
You know, you're already my best friend because you've said that you've increased your overweight on India. What was your overweight positioning? What was your positioning, let's say, about a year ago in India? And where is it now? And why have you changed it?
So I think it depends on which fund you're talking to. If you go globally, the allocation to India will be rather small because in globally, if you look into global indexes, India portion is small from a market capitalization point of view. But at the same time, if you look only at market capitalization, then you miss a lot of opportunities. Typically, within emerging markets, over the recent 2 years, to have good performance, you need to have India and you need to have Taiwan. And China has been costly. So the thing is, we have been reducing our allocation, our overweight to India, if you look at 1 year ago compared to now. India is a structural story for us. So it's the only place in Asia where you find so many companies able to deliver growth. So when you have a forward ROE of 15+%, you don't have a lot of areas when you'll be able to have that. Then the concern from investors was from the valuation perspective and the earning trajectory. And this is the earning trajectory for us that has been eventually leading us to reduce our overweight. Why? Because when you have earning revision ratios that are going down, and it's basically due to macro factors domestically, but as well external factors. The domestically, frankly, we are seeing positively the fact that there is fiscal consolidation in India. We do think this is a short-term pain to have a more structural growth story going forward. But over the very short term, it means that it's a bit more complicated for companies to deliver earnings. The second point is on CapEx. On CapEx in India, we have not seen private CapEx taking the baton, and we've seen consumption very strong. So this is a missing point where we have been saying, okay, let's take a bit some profit out and see if there are other opportunities where we are underweight in areas and it was allocating a bit more to that.
Since you just mentioned at the beginning of your answer that you were underweight India, now you are started coming back to India. Can you explain that point?
No, we have been overweight India and reducing the overweight on India. And tactically, we do feel now that large cap, after the recent, you mentioned initially in your introduction, India performance year to date, Nifty -5. MSCI China, +20. You have 25% performance differential in the matter of 8 weeks only. So it's substantial. We've seen outflows, you were mentioning about it. We saw 20 billion roughly of foreign investors selling India equities since the beginning of the year. They are reallocating into other areas. But at the same time, our strong conviction is the valuation, the ratings that we have seen has been stronger than the lower earnings delivery.
The Indian valuation derating is higher than the actual slowdown in the earnings.
Yes,
that's a great point.
In our view, yes.
So have you been a net buyer in Indian equities in last 6 weeks or last 8 weeks?
Last week.
Okay.
We have been coming back to it. And on the large cap, we do feel that the valuations that we are seeing on mid cap is still a bit expensive compared to what we are seeing from an earning revision ratio on the market. Of course, you can selectively find some stocks, but in general, we do feel that now on the large cap, most of the resit on the valuation has been happening already.
Could you go back to your original commitment to India in terms of the total exposure you had at country level? Do you see that going back to that level?
I think step by step it will be the case. One of the contingency is how the Chinese rally is evolving. Because the Chinese rally is a tactical rally for now, in our view, but it can become more sustainable. So the question is on the leadership. And we do feel okay having an overweight on India and an overweight on China today in our portfolio. The overweight on China is not sustainable yet, and earnings there is not good enough yet. Okay. So there is good prospect for Chinese companies to deliver more because the business environment is evolving. Because when you see some very strong platform, technology platform earnings, high guidance, strong capex over the next 3 years, so you see good commitment, but we need to see more of that to make it a bit more sustainable.
Okay, so again, I'll take the liberty of just summarizing our interview as we keep on going higher. First point, you said that look, US markets, according to you, they had become Humpty Dumpty and now they're losing some weight. But when money is moving out of US equities and US bond market and the dollar, it is moving back into emerging markets. As of now, the tactical trade is China, and India is more like a structural trade where you were not excited about a year ago, but you've come back in last 6 weeks and you expect that you're going to be here for next couple of weeks if earnings they continue to pick up. My next question about India is that you look at Indian earnings and then you look at the sectoral breakup as well. What within India you like in terms of themes and sectors where you overweight and when you are underweight?
What we have been adding recently, and we are more convinced on, is on the bank side, on the hospitals, for example, on the healthcare, and we have been adding as well some platform food delivery, for example. And those actually have been having a last quarterly earnings upside surprise. We didn't have a lot of upside surprise in the earnings in India, but I would say the previous quarters were disappointing. The last quarter is showing more strength. Not yet what we have been used to, because we have been used to very strong earnings in India, but we feel that it's coming back. And it's as well linked to the fact that consumption is very strong. And where we are a bit light in terms of exposure today is on the telecom, for example, in India. We have a bit this positioning. We have a preference for large cap versus small and mid cap as of today as well.
Okay. How much of your allocation is also a function of MSCI? Because in MSCI, the China weightage is very high, India weightage is low.
I think it depends on the mandate, it depends on the clients as well. But when we have the possibility to have freedom, we try to get rid a bit of the market capitalization and of indexes as well. I think it's important when you look at it to try to see opportunities. And if the opportunities is smaller in terms of market cap, it still deserves some allocation. So we look at it more in terms of risk budget allocation, in terms of volatility allocation, in terms of conviction we have. So typically we have been underweight on Max 7 for a long time. This has been costly, but we are fine with that. It's a strong conviction. And over the last 8 weeks, we have been making up a portion of the losses that we had over the last quarter, for example. So we are conviction manager, and when we feel that the market capitalization is too extreme in one area, we are happy to be underweight and to try to find the other pocket that is a bit disregarded, neglected, and that has good fundamental actually.
Okay, I'll take the clock back before I take it forward. We are in 2025, but if we were, let's say, sitting and discussing your India view in 2020 and today, what has changed in your total commitment? I mean, do you still like the same stocks? Have you added new stocks? Have you started liking new entrepreneurs? How has your portfolio positioning in India changed in the last 5 years? I'm not talking about the commitment levels, not overweight, underweight, but in terms of theme, ideas, and sectors.
So first, I will answer on the commitment. I think our exposure to India has been increasing massively over the last 5 years. Then the way we have been expressing our views has been, in terms of stocks, has been changing as well a lot. Because you have new stories in India. You have new development of sub-industries. You have new smaller companies that have been progressively climbing into larger companies. And more generally, I think in terms of macro stability, India has been now, for us, we are perceiving India and the way RBI has been communicating as getting more and more reliable. Foreign exchange reserve has been increasing. Inflation, they have been waiting before cutting rates. waiting more than other central banks. They were feeling a bit under pressure, but they kept steady. And now they have been able to cut, and it's right time. So in general, the macro stability has been a strong positive in our view, and the strong innovation. What's missing in our view, or what can be improved, is the manufacturing capability of India to become a real alternative in the China Plus One policy. China Plus One policy, US companies have been allocating here, Japanese companies have been allocating here, but mostly via services. On the manufacturing, I think there is a lot of things to do in India, where India can actually become a larger share of global manufacturing export. Today, India on manufacturing is progressing, but still from a low level. So I think we are willing to see a bit more manufacturing stock coming in, and some policies as well to favor this from a fiscal point of view.
There are two factors which don't support India for foreign investor. One is currency. The natural direction of the currency is 3%, 4%, 2% declines on an aggregate basis. Second is taxes. If foreigners make money here, they pay taxes. Is that a deterrent when you look at India versus China? Does India lose out because of these two factors?
No, I don't think so, but I think it's a concern. So I think investors are looking at it, and portfolio managers like us are looking at it, because you have to pay a lot of tax on the coupon you're getting on India bonds, and you have to pay a lot of tax on the capital gain you're making on India equity. And this is definitely a negative when you're building up your investment case, because when you have today in the company we have expected earnings for next 12 months in India of 13.5%. We are not far from the consensus. The consensus has been revised down. But then when you're looking into potential depreciation from the rupiah, and then you're factoring in a bit of tax as well on your capital gain, it's becoming less of a super buy story, because you may have mid-single digit P&L then over the long term. So one way of doing it, some investors have been trying to do it. We don't think it's an appropriate one, because it's lack of liquidity, is to go via GDR. So stocks, Indian stock quoted in London, you don't have a lot of liquidity there, and on top of it, you don't have small, mid-cap, and interesting business models that are developing. On the bond side, what we have been doing extensively is as well to invest in India SSA. So India, but denominated in dollar, where you have a slightly lower liquidity, but a better rating, sometimes better ESG rating as well. So we have been trying to tap into India bonds without committing into India bonds too much.
Good. Okay. You know, we're just enjoying a conversation so much that I've lost track of time, but there is a time which we need to honor. I mean,
of course. I've
been sending my appointment with you. So I'll just summarize with a few last questions. And I'll use the liberty of time here, which is, what do you like in the short term, which is less than a year? What do you like in the medium term, which is 1 to 3 years? And what do you like in the 5-year plus, which is the long term? What are your super buys? Short term, medium term, long term?
It's not an easy one, because I know from where I'm coming from, so I have behavioral biases. Now, I think short term, we do believe the China rally can become sustainable, and we do believe that the valuation there, despite the re-rating we've seen, is still very, very light. So we are back at 10-year average in terms of PE across all the indexes. So very short term, China can make a good profit. Over the medium term, India is a structural story, and we like this. Over the very long term, I think we will have to diversify further portfolios. So getting further away from the MSCI weight, to make sure that you are taking profit across the years, and you are reallocating to better areas that have not performed yet, or you will be mean reverting every time. So I think this is more the long-term strategic story and it means having a bit less of US going forward.
You know, I've always been wanting to ask this from Amundi, and when Ayaz used to be there, I used to ask him the same question. So I'll take the liberty of asking you this final question. Can you guess the question?
Will you buy India equity after our discussion?
No, nothing about stocks. No.
No, I don't know.
Okay. It's really about an investment process which you follow. So if you have to really share with our viewers and folks who want to look up to you, they want to understand how do they how do they start investing? It's called a checklist. So what is your checklist slide? 3 items on your checklist or 5 items on your checklist? We'll keep it crisp and short, and then I'll not extend my point.
No, it's relatively easy. You need to be fundamental investors.
Okay.
But if you're only fundamental investor and looking into the balance sheet of the company, and you look into the price you have to pay for these earnings in the company, you forget about one important point, that is the momentum. And if you look into only fundamental, then you miss a lot of stories that are purely sentiment driven and momentum driven. So you need to be fundamental driven over the medium term, but to be aware of what's happening on the momentum and to incorporate some positive momentum story. We don't want to be into laggards and contrarian every time.
What is the sunset sector according to you? What is the sunrise sector according to you?
What is the what, sorry?
Sunset sector and sunrise sector.
Yeah, well, it's difficult to answer on this one. In India only?
In India.
In India, it will be difficult for me to answer.
Globally?
Yeah, globally, I think typically the tech story now is a strong momentum in China, for example. But if you have earnings, that is becoming a perfect story.
Okay.
And it's not priced.
Okay.
The defense story in Europe, or the security story, defense story, it's a momentum story, but for now it's not yet an earning. So it's a pure momentum story, and it's difficult to have it in portfolio. Then you have some anti-momentum story, like India, but fundamentally, you should be in it. So this is why we are increasing India now, despite the fact that we have outflows.
Well, then you say India overweight. I'll say let's wrap the interview, but I'll do a high five with you right now. Let's do it. Thank you very much. Thank you for enjoying stay in India. Well, that's it on this very special show up deep dive as to where Amundi is looking at investing in the world. Remember, they are managing $2.2 trillion. So what they say really could influence the market going forward. Thank you for tuning in. Thank you for watching the show.
If you like this video, then like, share and subscribe to ET Now.